Good afternoon, everyone. I'd like to ask everyone to come in and get settled so we can get underway, begin our afternoon session. We did a pretty good job this morning, I think, staying on track, and we want to try to do it this afternoon, but it's going to be a little bit more of a challenge. We've got 3 sessions here back to back, so we're going to get going in a second here. In fact, I will invite my panelists up to the stage, and we'll get underway. My panelists are engrossed in conversation among themselves. That's how interesting they are. You're on the end, Peter. Thank you. My name is Michael Drain. I'm a Senior Vice President at Ginnie Mae. I lead our efforts in strategic planning and policy. I'm going to say just a couple of words about this session, and then I'll introduce our panelists, and then we'll start the dialogue. I think of this session as being partly a continuation of the dialogues that we've had at, I'm pretty sure, each of our 4 previous Ginnie Mae Summits. And we talked about MSRs really from the standpoint of industry practitioners. Who's buying MSRs? Who wants to own MSRs? Who doesn't want to own MSRs? Why don't they want to own MSRs? How are MSRs financed? What's the difference between owning MSRs and servicing loans, and how is that changing? We've talked about all of those things, but as I said, largely from the standpoint of industry practitioners. So today we're going to talk about some of those same issues, but looked at from the standpoint of analysts of the industry, analysts of the companies that perform these functions. Our panelists today are all individuals whose professional role in one way or another has been to analyze this industry that many of us are part of and the firms within it. So I think they'll have some good perspectives on an area that continues to change fairly dramatically from year to year. So I'll quickly introduce the panelists and invite them to say more about themselves during our conversation. First is Nancy Wallace, who's a professor of finance and real estate at the University of California, Berkeley. Chris Whalen, who is an investment banker and author, and from 2014 to 2017 was the head of research at Kroll Bond Rating Agency. And Peter Sack is a managing director at Credit Suisse and the head of Credit Suisse's mortgage finance unit. So Nancy, I think I will start with you. You achieved world renown as one of the co-authors, one of the 5 co-authors of what I think is commonly known as the Brookings paper. It was published last spring. The formal title was Liquidity Crises in the Mortgage Market. And the way I would describe that paper was that it was an attempt to elevate and illuminate the issues of liquidity in a world that was becoming increasingly dominated by non-banks. Why don't you start by telling us a little bit about your professional field and how you got to putting all that work into that paper and what some of the things are that you've been working on coming out of that.
Great. Thank you very much for having me. It's really a pleasure. This has been an incredibly interesting conference for me. So I'm the person that trains the people that go to all these firms. So I train people in how to price mortgages and how to think about aggregate risk and how to do risk management. And what are the tools of the trade? How do you hedge? How do you price? How do you quote yields? How do you assure that Ginnie Mae meets its mission to connect this bond market to the global capital markets? I've been working on mortgage markets for a long time. I run a lab, and we have 72 terabytes of data, which was a very long process in putting together, where we see into this market, starting from the loans, all the originators, all the houses that have the loans, not just on the residential side, but also commercial. And then over a long period of time, what's the performance of the loans? And we heard this morning much about the subprime market and understanding how that failed. But the other story in subprime is there are still a lot of subprime mortgages outstanding, and people are paying their mortgages. So I think there's a lot to be learned from the prior data, and obviously linking that to the current data, which is much more Ginnie Mae, which is the subject of today, and also the GSEs, obviously. So how I got into this is, obviously I'm right next to the San Francisco Fed. I do a lot of policy work. I sat on a PIMCO board, so I see a lot of what's going on in the trading and the mortgage market, and a singular feature that I noticed was that nobody had the data. So mortgage data is very complicated. There's no mortgage loan ID. So different from the bond markets that many people are used to, there's no way of easily tracking the instruments. And so my first mission, naively, was to try to get the Treasury through the FSOC or the Fed or someone to have an ID function for the mortgages, hopefully one that showed provenance. We never achieved that, so that was a singular failure in coming out of the crisis. But we also don't have really mortgage data sets that easily link the full contracting space, like all the elements of loan to value, debt service coverage, something about income, something about racial or ethnic status of the loans. And so really or even where the loans were originated, who the true lender of record was. So understanding the full supply chain was essentially impossible pre-crisis. Now it's simpler because most things are going through Fannie and Freddie, so there's a somewhat simpler supply chain. But one of the big efforts that I was involved with at US Treasury is trying to build networks of how this market actually works. And we heard earlier this morning that non-banks are not all the same creatures, and understanding their funding structures is absolutely essential. And that was something we worked on a lot right after the crisis, and trying to understand how the subprime market, which was also largely non-banks or heavily warehouse funded or repo funded or ABCP funded entities, actually functioned, and what their supply chain was, how a mortgage flowed all the way through to the securitizer. So the concern was that without these data, it's very hard to see aggregate risk in the US economy. And in my role as an academic or a person training people to go into this market, or working with regulators, both of the Federal Reserve System and also the US Treasury, it's very important to meet the obligations of the bond market, which is the bond should be actuarial, we should be able to quote yields that people can believe in, at least in an expectation sense. And in order to do that, we need the data. So pre-crisis, another problem was just the speeds at which you could sell a loan, which was why understanding the network was so important. Now the issue is understanding counterparty credit risk. And that was another function pre-crisis, and the other derivatives markets of understanding clearing, understanding how these networks work. And now we have the situation where we really need to understand the counterparty risks and what kinds of risks are outstanding, both in the economy and certainly for entities like the GSEs and especially Ginnie Mae.
Let me throw in a question. Is there a dramatic difference between the data that you have available on counterparties when the counterparty is a bank versus when it's not a bank?
Yeah, so the big learning and the reason for the Brookings paper, which is basically why we did the Brookings paper, is that getting the funding structure of these entities is extremely difficult. We didn't have the data. So I had the data through bankruptcy filings. A lot of these data are offshore or they're in ABCP, so you can get it from the rating agencies in very complicated ways. But we still don't really have the data on who the counterparties are, what their capital structures are, what the correlations are, how many counterparties a given entity has, how much they're using the repo market. We simply don't know that information. And the only reason the Brookings paper existed is that the Fed, through DFAST and CCAR, now has the Y14 data, and the Y14 data gives at least through the banking source of this capital, information on the warehouse lines, their margins, how they're structured, how many lines on average different entities have, but it's only the banking side of things. So the Brookings paper is really in my view, a clarion call that we need these information if we're going to understand aggregate risk related to the mortgage market, and we do not have it. And the effort has to be, and I salute Ginnie Mae for its efforts to try through the discussion with the large non-banks in January, and also the effort to get a better handle on what their counterparty exposures are.
Let me ask Chris to pick up from there. Chris, you were in a slightly different situation in that as part of a rating agency, you presumably had access to a lot of data because they were your clients. So how would you talk about the implications of this transition from banks to non-banks as an analyst?
Well, first off, thank you for the invitation, Michael. Really, the way I look at the world is non-banks are the private sector. Banks are government-sponsored entities, just like Fannie Mae and Freddie Mac. And so expecting non-bank companies to compete in this Jurassic world where there are these super entities that have sovereign credit ratings is almost unreasonable, I think. In the ratings profession, yes, we get confidential, non-public information from any issuer that seeks a rating. But I think it's important to remember that private companies that are not depositories and that are not subject to Section 12 of the U.S. Code have no, compelling responsibility to disclose. These are private businesses. And even though they do fit into the grand scheme of things in terms of risk and, the economy and everything else, ultimately, I think we have to respect the fact that they don't have subsidies the way a bank does. They don't have federal deposit insurance and access to the discount window. And in the ratings world, you give a bank automatically a full notch of uplift in their rating simply because of government sponsorship, sometimes more than that, by the way. So, in an aggregate sense, if you step back and say what's changed in 10 years, Michael, the risk is the same. It's just now we have seen banks go from taking the risk directly, both as lenders, as sellers of loans, as packagers of mortgage-backed securities. Now the banks are simply providing credit to non-banks, mostly on a fully secured basis, by the way. And when you look at most non-banks after their pledge of collateral, their pledge of their MSR, their pledge of the office furniture, there's no net capital left. That's just the way this industry works, and it works because the loans and the securities are guaranteed by the United States. The day that is no longer the case, for example, if we were to take Fannie Mae and Freddie Mac out of conservatorship, well, the good news is the private label market will be much bigger. But for me, I work with an investment bank in New York that provides financing and TBA and everything else for small and mid-sized mortgage companies. And when we do a repo transaction today with any collateral in the agency market, it's all the same. But if we were to mess around with Fannie and Freddie and start to pretend that they're private companies, that changes a lot. And the cost of capital to the non-banks would change, and they would all come to you, Michael.
Yes, they would.
Do you see much likelihood that this evolution is going to continue in a way that would see today non-banks, large non-depositories, actually seeking to become banks? And would that even make sense?
Yeah.
Well, you've seen a distinct trend among the banking industry over the last 10 years in a couple ways. One, the portion of their balance sheet that they allocate to holding whole loans is slowly declining. It used to be 20%, and it's down around 11. They're not selling as many loans. They're looking at keeping larger, higher quality loans on balance sheet and largely withdrawing from the market. So for example, the FHA market. And you could blame this on False Claims Act activity by the Department of Justice, but I think it's a more profound trend. It has to do with the price of the risk. It has to do with the fact that our friends at the Fed are constantly forcing interest rates down to try and propel consumer activity in the economy. And so you're left with a corpus of assets that no longer have any carry. And this is a big deal for the industry because 10 and 20 years ago, just owning the loan against funding was kind of okay. You didn't have to sell a loan. You could just sit back and earn the spread. Today, we're at the lower bound of interest rates, and we have a flat yield curve. And as a good friend of mine, a very veteran short-term treasury trader said to me, he goes, Chris, it's different when you have a flat yield curve at the lower bound because there's nowhere to go, as an operating business. So I think the banks are not going to come back for a while. It's Basel, it's a whole list of reasons why they just don't see the risk-adjusted returns of a 1 to 4 family loan as being that attractive, especially a small loan. If it's above $500,000 and they can collect 25 basis points on it and high FICO borrower, okay, they'll buy those all day long. But they'd rather have a $5 million jumbo made to a condo purchaser in some big urban area. That's your sweet spot now.
Peter, why don't you step in here? You're a representation in a way of something that's been talked about a little bit earlier as well today, which is that banks are perhaps not directly participating in mortgage origination and servicing in the way that they might have, the larger commercial banks anyway, 10 or 15 years ago, but that doesn't mean that their exposure has lessened. They're playing another role in the system. Why don't you talk about that?
Yeah, that's true. One effect of the migration to a non-bank market, or more of a non-bank market, in the Ginnie space certainly has been, while it's true that the banks still have risk in the form of bilateral repo, there has been, one noteworthy event of the last couple of years has been the growth of the securitization market for MSR financing. And that has, it's attracted a lot of attention, and it implicates a lot of, what have been described as sort of some benefits and some costs. And certainly one of those costs is, as Nancy alluded to earlier, potentially a reduced visibility into a number of data elements that would be helpful to, be more observable. And maybe some complexity also in the balance sheet and the capital position of some of the counterparties, but it comes with a lot of benefits as well, which is, to name a few, an increasing diversity of funding sources in securitization market investors across REITs and money managers and insurance accounts. At least at the moment, a substantial reduction in funding cost, given that different from negotiated bespoke bilateral repos, you're putting the market in comp to provide financing.
Yep.
It implicates new risks in that market conditions can change, investor appetites can ebb and flow, and that can create some disruption. On the other hand, it allows originators to ladder their maturities in a way that they certainly can't in the overnight repo market. It still implicates some mark-to-market risk, but subject to a lot of constraints or at least benefits on the part of the MSR investors. So that has been, a signal development in the last couple of years. It's certainly the case that banks own a lot of loans on their balance sheets, big loans and different kinds of loans, and they are participating in the market and providing funding in significant ways, even if they are not always directly the originator of the loan. But there is a greater capital markets involvement in Ginnie and in MSRs in particular than there had been before. And I think that you could argue that those diversification and funding cost benefits, the broadening of the market away from just banks, may more serve benefits that at least offset the negative components.
Some of these new sources of capital, and you've had a lot in the structure that you worked out initially with Ginnie, and I think is now spreading to the GSEs. Some of these new sources of capital have never before, they're represented by institutional money managers who, I think it can be said, have never before had this kind of direct exposure to MSRs that they have now. And the numbers are getting pretty large, so I'd be curious for any of the panelists, what observations would you make about that, these new sources of capital that are coming onto the scene? How are they going to assess whether their investment has been successful or not, and how are they going to use their own resources to kind of figure out what the risks are and whether this is really a good long-term investment proposition.
Yeah.
Chris.
Oh, I think it's fascinating that the audience for MSRs has expanded enormously, as our colleague was just describing, but at the same time, that asset class has been whipsawed by the same forces that the bond market has been dealing with, which is the Federal Reserve. You know, MSRs are one of the best performing fixed income assets in 2018. And today it's trading at, you know, extremely high multiples compared to the historicals. The thing I worry about a little bit with investors is that, sure, they thought, God, this is a great asset class, we're really interested. All of the big buy side investors are either involved in MSRs or they've also become a sponsor behind a lender at the same time. But I think that the full appreciation for the capital components of the asset, and particularly the degree to which you're short a put position essentially with respect to capital in the event that the cash flow going through the asset is insufficient to take care of loss mitigation. So you have to be willing to be patient, and you have to be willing to really work with your servicer and your lenders in order to manage that asset through the life cycle, which could be 15, 20 years. So I worry a little bit that as we normalize interest rate policy at the Fed, we may see some of the pricing move back. Look at what we've just been through. I mean, the 10-year is headed through 2%. So I think when we look at earnings this quarter and look at the effectiveness of hedges versus the long position in the MSR, it's going to be very interesting to see how both the banks and the non-banks are managing that.
Right, and also these are runnable markets, so they have never been safety and soundness stress tested. So it's very hard to understand what the cycle effects on some of these players are because A, we don't see into the markets well, especially the stuff that's offshore and securitized, and B, there's no unified way of stress testing them as things stand now. And we know, you know, they're like an IO, and we know there were huge losses when interest rates turn against you in that kind of a market. And are these firms really set up to deal with that? And right now we have no transparency or visibility into that truth.
Well, I think it's important to consider also that the transactions that Michael was alluding to, and I just remembered I need to say at some point out loud that my comments are my personal opinion, not those of the bank. Maybe I speak from. The transactions that I'm thinking of that I think Michael was alluding to are financing transactions. Mm-hmm. Those securitizations are essentially loans to the MSR owners. They are not themselves principal trades in the MSR. Right. So the buyers in those securitizations, whether they're money managers, as many are, but also REITs and insurance accounts, they're not really buying MSR per se. They're collateralized by MSR. So they have exposure to the market value of the asset, but these are fundamentally an alternative to repo financing. Mm-hmm. They are not actually MSR trades. I do think that as the market continues to evolve, and we've been impressed, or personally I've been impressed by the extent of expertise among the investors in those transactions so far and how well they understand the asset. But I think it probably will continue to evolve such that some of the elements, the structural protections, because it's a pretty nuanced legal transaction, mm-hmm. Given the liens and the dispute resolution issues and so forth. Some of those financing transactions will probably lead to an increasing liquidity in the underlying asset and inform structures on MSR principal trades separate from the financings. So this is an evolving environment. I don't think that we've leapt quickly from a bank-funded market to a money manager-funded market in one fell swoop. But there have been some incremental evolutionary steps in which I think Ginnie has been a very constructive, participant and innovator that are leading us to a place where, ideally we'll have a market with greater liquidity, a diversity of participants, and potentially greater, therefore, risk mitigation through market turbulence and and other, unforeseeable events.
Well, again, one thing we should mention, Michael, is if you looked at 3-4 years ago compared to today on the terms for financing MSRs, they've improved dramatically. I'm a little bit concerned that we may be at the point where it's as good as it gets in this cycle. And so the question is, can we go through rising defaults and not see banks start to back away from that 70% haircut on Ginnie assets and go back to 60 or 50? Because what is absolute death for the non-bank sector is if they get cut off.
Yeah.
The banks can kill them with a phone call.
Well, I think that is probably maybe the leading argument for greater diversity of funding sources.
Right.
That it's not one phone call with a person in a bilateral repo.
Exactly.
It's a structure that defines the events that can cause changes in the terms, and it's a market transaction where one person at one institution might have a view that's different from a diversity of other buyers. So,
except for the contracts, I haven't seen as much on the securitized side, but a lot of these contracts, you have more than, for one institution, you have more than one provision of financing. And so the covenants, as I've seen, are very much a daisy chain, that if any one of them pulls the line, all the rest of them get to.
I think that's
so it can run quite quickly once you get a spark.
I think that is commonly the case, but I think part of the concept of the capital markets transactions is, while it's certainly the case that often lenders will have multiple repo arrangements that all have covenants that are triggered by the occurrence of some event that precipitates an event of default that triggers a default under all the repos. The structure of the securitization transactions to date, I think it could be that it mitigates a bit that risk of a domino effect or daisy chain effect, because those are not events that are fairly empirical. They're a factual situation and not a decision on the part of the person in the credit department at the bank to waive or not waive the event of default. I don't think anyone is under the illusion that this has been perfectly figured out. But my personal opinion is that we're at a point today versus a couple of years ago where we've gone from an asset that is at least a bit constrained with respect to valuation by the fact that there are very few people who can actually, there's very little leverage available because there are few people who can actually provide the funding, to now a market where, at least for some of the large market participant lenders, MSR owners, there is a much greater availability of financing, and that probably, it's very hard to say rate adjusted, but that certainly seemed to, at the time, given the significant reduction in funding costs that resulted very quickly from the emergence of those transactions, does seem to have been related to an increase in liquidity and a reduction or an improvement in valuation of the underlying asset. And that's just generically true in capital markets, right? If the thing becomes more financeable, it tends to appreciate.
But what's interesting is that the evolution from the short-term financing to the term financing that Credit Suisse did such great work on, to perhaps even an equity owner of the MSR, and then turn the servicer into basically the subservicer. And if I could say, go buy a bank. Because to me, the risk-adjusted returns of the subservicer as a bank, Flagstar, for example, are much, much higher than a small non-bank with no float trying to finance the whole MSR or maybe participating part of the excess strip out just so they can get more cash and go do it again. These are cash-constrained organizations. So if we could eventually get an insurance company or a fund that has the long-term capital to fund these assets, I think that would be an optimal, if you will, replacement for a bank.
So do you think then that if we, this is of interest to me because of course Ginnie Mae has talked quite a bit recently about our desire to find ways of bringing non-traditional capital to finance MSRs. Are you suggesting that if we were successful in being able to do that, and non-traditional capital had a bigger role, that would be a path for the reemergence of banks purely on a operational servicing because of the advantages that they have with being able to capitalize themselves?
I think possibly, and in particular, if you look at the rules for small bank holding companies below $3 billion, they are very flexible. Small bank holding companies are not subject to Basel. Yeah. So right off the bat, you can keep 100% of your tangible common equity at the parent level in mortgage servicing assets. Mm-hmm. It's like the old Reg Y, that's what it is. Yeah. To me, a well-run firm that has float and that has the fee income from servicing, but at least shares the capital risk in the asset is a much better business model. It's much more stable. Will all banks come back? No. But I think there are enough of them out there that do like the residential asset that they will kind of go back to the future, if you will, and have mortgage specialization banks that do that primarily, maybe with a retail component and a wholesale component.
Mm-hmm.
Sorry, go ahead, Nancy.
But I think in order for this to work, and I'm a big believer in securitization, that's what I teach, so I hope you're right. We need transparency into these vehicles, and that's got to be through the data mechanisms that Ginnie is trying to build, so that we understand what all of the implications of these new instruments really are. And I think that's been a chronic failure in all these experiments, that people are way out ahead of where the actuarial data are to understand what we're talking about, whether we've increased risk or decreased risk. And I think we're in that place right now. We just don't have the information.
And are you talking, just to be clear, are you talking about?
I'm talking about loan level data that are linked with specific issuers, specific counterparties, specific contracting elements on the MSR security.
Well, it's like Ed DeMarco said this morning.
Yeah.
You want to make it easier to make these public deals.
Exactly.
But with Reg AB now and all of, Eric Kaplan has done a lot of work on this at Milken. The complexity of the deal documents today is really daunting in terms of getting them to a public market.
Yeah, just one other comment, back to the Brookings paper. When we were given permission to write that paper for Brookings, because I'm a mortgage person, and we all speak a language that many macroeconomists have no idea what we're talking about. We had to rewrite that paper 5 times to get it into plain English. I mean, to explain these contracts in plain English, which the SEC now requires all of us to do, is actually very difficult. And to get normal, highly educated macro people that are very concerned about macroprudential policy making to understand what we do in plain English is imperative. And that took a lot, and I fault myself that I had to learn to speak plain English to write that paper with my colleagues at the Fed. And I think it's a fault of our industry that we don't make that effort very frequently.
Speaking of macro-prudential policy making, I think, that if I know what that means. And also speaking of Ed DeMarco, he made a comment this morning that I'd like to get people's thoughts on, and it was about capital, and he was talking about, and I hope I do justice to this, that there are disparities in how the various people that take opinions about how much capital, say, a non-bank should have, as Ginnie Mae does, there are disparities in how the different entities assess how much capital is required in this business. And he seemed to feel that it was very important to work hard to get that on more level playing field in order for us to be in the place where we need to be when we inevitably hit adverse circumstances. So what are thoughts of the panel about capital requirements for non-banks in particular and where we should be going there?
Well, I'll start. I think, again, the non-banks are compared and they must compete with government-sponsored entities. So right off the bat, they have a very tough road to hoe. Funding, in the 80s and 90s, little mortgage companies could issue their own pass-throughs and sell these securities to money market funds. They're not allowed to do that anymore. In fact, before long-term capital management failed, they changed Reg 2A7 and they handed the banking industry a monopoly on short-term finance. So all of the risk is in the banking sector, and the assets are owned by the GSEs, let's remember, and the non-banks are essentially allowed to rent them and play with them. But they don't have enough capital to own them on a freestanding basis. And that, to me, it's almost hard to answer your question, Michael, because if I'm competing with a bank that runs at 15-1 and has subsidized funding, it's kind of hard for me to set a level playing field. If I got rid of the GSEs and I just had Ginnie as the policy vehicle, okay, maybe that broadens the market enough that we have room for the private sector to work. But the differential in pricing is still going to be rather dramatic. I mean, it'd be a couple points, wouldn't it?
Agreed.
Agreed. I mean, the other interesting thing that was brought up earlier is the role of the FHLBs with advances. And that is a pooling equilibrium. They're making everybody pay the same amount, whether they're big, whether they're small. And it is bringing liquidity to the small guys in a fairly transparent way. And it seems to be having quite a large effect in terms of mortgage flow for the smaller originator, who then hold it on their balance sheet.
Yep.
So it's possible that that vehicle could, I'm not so sure about pooling equilibria when you're trying to price risk, but it is at least a model that would make it more accessible and more of a level playing field.
Hey, look, sell the new platform to the home loan banks. Let anybody who has eligible collateral play, or even private deals. And then, unfortunately, we don't need the other two corporate entities.
I agree with you.
We have just a few minutes left here, so I'll ask a question, and anyone can jump in and answer with your thoughts. We, in a paper we wrote not that long ago that talked about our observations from a series of meetings that we had with our largest non-bank issuers earlier this year. We were, I think, fairly frank in acknowledging that this world that we're operating in has changed a whole lot. And speaking for Ginnie, we're proud of the work that we've done to try to keep up with that in our risk management and policy work. But there's no presumption that we've been completely as successful or that we're all the way there. There is certainly a whole lot more work to do. So I'd be interested in any thoughts anyone has looking at the government now as to what the government can do. And I mean, let's say, apart from housing finance reform and conservatorship and all of that, let's make that a separate issue. But what can government do to better adapt to the world that we're operating in now in terms of capital regulation or policy or programmatic changes or anything you can think of? What advice might you give?
Well, my one's easy. As an academic and working with regulators of various types, is to increase the loan level accessibility of what you actually do. And I think that's a huge problem, being able to track loans into pools and then how we split the pools into the IOPs or whatever we're going to create out of the pools. We need transparency in that full supply chain. Mm-hmm. And that could be very easily provided by Ginnie, and right now it really isn't. And that would be very helpful for these capital markets in terms of just understanding competition, who are the players, how is risk aggregating, at least in the type of products. Of course, we don't see into the financing piece of it, and if you could provide that. And I think the Council of State Banking Supervisors could make that more open as well, and I think that is the intent through the Federal Reserve System, and I think that is also really positive. So on that side, that would be a big advantage.
Well, two things, Michael. I think, number one, it should be at least a medium-term goal of FHA and Ginnie Mae to make the resolution process, the claim process, the loss mitigation process no more costly than the GSEs. Yeah. There's no reason for that bifurcation. I know it's difficult to say, oh my God.
Yeah. Good job.
And then the other thing is, I think, working with a couple of issuers myself, I would like to see Ginnie clarify exactly what their expectations are from issuers, especially if we're going to tell everybody to manage their business to a Moody's single B rating. Having written a finance company methodology, I'd like to know which parts of the document we should focus on. And I think that would be very helpful for a lot of non-banks.
Thank you. Peter, we have just a few seconds. Any closing?
I think that's a great finish. I have no suggestions for the government.
Okay. Well, I would like to express my appreciation for our panelists. All of them came in from out of town for this. Nancy came a very long way. So this has been wonderful. I wish we could go on for longer, but I very much appreciate your time, and I appreciate the attention of the audience. Thank you very much.